Sausage sales are soaring, and it's not because of a sudden meat craze. In September 2024, this unexpected economic indicator is hinting at something bigger. But what exactly? Felix here. Today we're diving into a strategy that could help you navigate these uncertain economic waters, especially if you are someone who's not keen on riding financial roller coasters. Let's talk about some of the safer strategies for those who are having maybe a lower risk tolerance day to day. Now, you might be wondering, Felix, how reliable is this information going to be? How reliable are these three stocks going to be? Well, let's just say my golden retriever, Winston, has been sniffing out some interesting economic data here. But in all seriousness, our teaching portfolio speaks for itself. We're up 80% plus so far this year. And if you fancy learning those methods, well, come and join our beginner trading training this coming week. There's a link down below. You can click on it. It's completely free of charge. It's part of our mission to make 1 million people financially free. But first, let's unpack why economists are eyeing a potential mild recessions and how these stocks could be your financial lifeboat. Plus, we'll explore a clever cash hoarding strategy that might just surprise you. Now, let's talk about why economists are eyeing a potential mild recession. And yes, it involves sausages, which is why Winston's here. You see, there's this quirky little thing called the sausage indicator. When times get tough, people tend to trade down to cheaper protein options. And right now, sausage sales are sizzling. But before you rush out to invest in pork futures, let's look at the bigger picture. We're seeing a real mixed bag of economic signals. On one hand, our second quarter 2024 GDP growth was revised upwards to a very respectable 3% just before the election. No coincidence there. No. And unemployment is relatively low. We're not seeing widespread layoffs yet. Sounds peachy, right? But here is where it gets a bit, well, dicey. Business equipment spending has been flatter than a pancake since autumn 2022. Consumer spending power is weakening faster than an overcooked bratwurst. And remember those sausage sales? They suggest some financial stress at the household level. Now, historically, recessions often follow periods of mixed signals like these. It's like the economic indigestion after a sausage feast. But here's the kicker. The lack of severe stress in key areas points to a milder downturn. As we discussed before, we've triggered something called the SAM rule, a recession indicator that goes off when the unemployment rate rises by 0.5 percentage points or more. It's like the smoke alarm in the economic world. So why mild? Well, it's a bit like ordering a spicy sausage and getting a mild one instead. Now, I must say, I'm a vegetarian, so I can't actually comment on sausages, but it seemed like a good analogy. Anyway, you'll notice the difference if you order that, I imagine, but it won't set your mouth on fire. We're seeing slowdown signs, but not the severe stress that typically precedes a major recession. Now, if the thought of market volatility makes you more queasy than a roller coaster after, some of those things we keep talking about here, there is something that could be more stable here. And the first idea would be, well, dividend stocks. They're kind of like the comfort food of the investment world, right? Dividend stocks are shares in companies that regularly pay out a portion of their profits to shareholders. It's like having a tenant who actually pays rent on time, a steady income stream that can help cushion the blow during market downturns. But why are these particularly appealing right now? Well, in times of economic uncertainty, like our potential mild recession, companies that can maintain their dividend payments are often seen as more stable and reliable. They're the financial equivalent of that friend who always shows up with snacks to the party. Now, dividend stocks offer some tasty benefits. One, income stream. Regular payouts can help offset potential capital losses, and you can take those payouts and potentially buy cheaper stocks. Historically, they have lower volatility. These stocks tend to be less jumpy than their non-dividend paying counterparts, and they can have also potential for growth. Many dividend-paying companies are well established and still have room to grow. Now, of course, no investment is without risk. Dividends can be cut or suspended, and these stocks can still lose value. So let's look at 3 dividend stocks that have actually caught Winston's eye. Let's talk about our first pick here. Arbor Realty Trust, 6.25% Series F preferred stock. What? Well, the ticker symbol isn't much easier. It's ABR.PR.F, I'll put it on the screen for you. This little gem is like the Jeeves of the investment world. Reliable, allegedly, dignified, and always ready with a steady income stream. So ABR currently offers a 8.5% yield. That's like having a tenant who not only pays rent on time, but also throws in a bit of extra money just for good measure, right? So what exactly is a preferred stock, you ask? Well, it's kind of like getting the VIP treatment in the investment world. Preferred stockholders get dips on dividends before common stockholders. And they're higher up the pecking order if the company ever goes belly up. It's like having a fast pass at a theme park, but for your money. Let's break down what makes ABR special here. 1, the fixed to floating rate. So it starts with a fixed 6.25% dividend rate. It then switches to a floating rate based on SOFR plus spread. So just a certain amount above the interest rate. So it's like having a savings account that adjusts with interest rates. Quite handy in our current economic climate. Now, of course, interest rates dramatically drop. The yield will drop somewhat too. It's issued by a REIT, Arbor Realty Trust, focuses on multifamily and commercial real estate loans. It's like investing in a property without the hassle of fixing taps and chasing down rent checks. Now, I do like residential real estate, but I am a bit iffy about commercial real estate just because there's so much vacancy. But number 3 is also something to bear in mind. The dividends are non-cumulative. So if they miss a payment, it doesn't pile up. So it's sort of a use it or lose it kind of a scheme. So what are the benefits? Well, you get a higher claim on assets and dividends than a common stockholder. Potential for increased dividends if interest rates rise, which seems unlikely. So the opposite is likely to happen. But you just get greater stability because it's got this preferred status. But remember, of course, every investment comes with risks. Preferred stocks can be called by the issuer after a certain date, which means they just buy them back, you get your money back, but you got to go find something else to do with your money. And as I say, they're sensitive to interest rates. So why am I bringing this up? Because you could argue that the commercial real estate space has gone through the worst period, and REITs have gone through the worst period because rates have been so high and it hurts them because they basically have to finance, their purchases. So this could be the moment where the REITs come back, and therefore you could get a double whammy of relatively high dividends and a pretty decent capital appreciation. But don't stop here. We've got 2 more dividend stocks coming up. And our second pick is the iShares Global Infrastructure ETF. The ticker symbol is IGF. It's kind of like having a passport to a worldwide infrastructure investment without the jet lag. So IGF basically offers exposure to infrastructure companies around the world. We're talking about transportation, energy, water, you name it. It's like owning a slice of every motorway, power line, and water pipe you can imagine. Currently, IGF yields about 3%, which is pretty good, and not as juicy, of course, as the first pick. But remember, we're playing the long game here. It's kind of like planting an oak tree. It might start small, but give it time, and you might have a mighty portfolio down the road. So let's break down why IGF might be worth a spot in a dividend portfolio. It's pretty diversified. Over 75 holdings spread across multiple countries, sort of like the United Nations of infrastructure, if you will. Steady income? Yeah. Infrastructure assets generally generate pretty stable cash flow. It's basically like owning a toll bridge. People always need to cross, rain or shine. And it's a pretty good inflation hedge. Many infrastructure companies can pass through inflation in their pricing. Now, you might be thinking, hang on, Felix, isn't inflation behind us? Well, interest rates are coming down. If the government keeps spending, we might just see a little bit more inflation down the road, and it might just stay a bit more elevated for longer. So let's look at IGF's benefits here. Well, exposure to multiple countries and sectors and reducing, therefore, single country, single stock, single sector risk. Potential for long-term growth as global infrastructure needs expand, and they will, and at least in my opinion, and it's a lot more liquid compared to owning an individual infrastructure stock because it's an ETF. You can just buy and sell it very, very easily. But of course, every investment has risk. IGF could be affected by economic downturns, currency fluctuations, and all sorts of things. But if you're looking to add some global flair to your dividend portfolio, IGF might just be your ticket. Now let's drill down into a final dividend stock. And I think I rather gave it away there, didn't I? Chevron. ticker symbol CVX. This oil giant is like a well-oiled machine in the world of dividends. And they currently offer a dividend yield of 4.4%. But more importantly, they've increased their dividend for 37 consecutive years. That's longer than some of you have been alive, and it's therefore a pretty good indicator that they know what they're doing. They are projecting free cash flow growth at least 10% annually through to 2027. And that's just based on a $60 per barrel oil price. So let's break down why Chevron might be worth a spot in your portfolio. What? 37 years of dividend increases. That's no small feat, right? They just keep getting better and better. Strong financials, projected cash flow growth is very strong balance sheets. It looks like their dividends are well supported. And 3, there is some upside here. I think Chevron is a growing business. I think oil isn't going to go away. And likely there'll be less and less investments in the space from other players because it's sort of seen as, well, oil is a dying industry. And what happens? The people who are left standing tend to benefit tremendously, much like tobacco. So with Chevron, you've got long-term dividend growth, you've got exposure to global energy markets, and it's currently trading near a one-time low. Could therefore offer an interesting entry point. But of course, let's not get carried away. Every investment has its risk. Oil prices can be volatile, and maybe we will all sing Kumbaya around our windmills or something. So changes will happen, and there are risks in the oil sector, though I generally believe that these guys will continue to make more and more money. But now that we've explored these 3 dividend options here, let's talk about another strategy that could help you weather any economic storm on the horizon. Remember when we discussed hoarding cash while waiting for that perfect moment to pounce on juicy growth stocks? Well, there's a twist to that strategy that could actually work. Enter the iShares 0 to 3 month Treasury bond ETF. The ticker symbol is SGOV. It's sort of the James Bond of cash management. It's currently paying a yield of about 5.2%, and the expense ratio is very, very small. So it's kind of like finding a savings account that actually keeps up with inflation. Think of SGOV as the perfect dish at your financial buffet. It's not as exciting as the growth stock or as comforting as the dividend stock, but it's the reliable thing that keeps you balanced. So why might it be a smart choice compared to holding cash? Well, you get a higher yield, you get 5.2%. That's significantly outperforming most savings accounts. And it's got a pretty low volatility. Look at the stock chart. The price barely budges, giving you some peace of mind. And it's incredibly liquid, so you can get in and out of this thing pretty much like cash. So if you have a lot of cash lying around, you might want to preserve the value of that and potentially get some higher returns by putting it into something like this kind of ETF. Of course, there are risks with everything. It'll be affected by changes in interest rates and government policies and so on. But it's a pretty stable and steady thing, probably as stable and steady as you can get for getting 5.25%. So let's wrap up the whole thing here. We've journeyed through the land of mild recessions, dividend stocks, clever cash management, and had a bit of fun in the process. But remember, we're not trying to predict the future. We're preparing for it. It's like a good Boy Scout or a well-trained golden retriever. By combining dividend stocks, maybe like a REIT, like we touched about, maybe like an infrastructure ETF, and maybe a dash of Chevron and maybe a dash of SGOV for your cash management, you're creating a more balanced, versatile, reliable, and ready for whatever the economy throws at you sort of portfolio. And the benefits are income generation with dividends, potential capital appreciation, some diversification, and just efficient cash management. So, of course, everything comes with risk. So you want to do your own research and dig a little bit deeper and ask all the smart questions and so on, because markets can be unreliable. If you want to learn a bit more about how we do what we do and how we're up 80% on our portfolio so far this year without super fancy methods, in fact, it's just 3 steps. It's actually very, very simplistic. Then come and join our beginner trading challenge this coming week. The link is down below. It's at the top of the description. And from Winston and me, I thank you for watching. If you enjoyed this video, share it with a friend, and I wish you all the best. Why am I flipping and telling you I'm selling my SoFi stocks? The answer is not what you think. Felix here, and today we're diving into a strategy that could potentially multiply my returns on SoFi by 4x.